Hello. Today I'm going to talk about quite a few different things. First and foremost, the release of the newly updated stop loss module. It is a complete and total rebuild that has taken a year to get right. I have that on the screen now, and in fact I'm going to unveil the approach I am using to demonstrate its many features. I'm using a classic momentum MACD RSI. Now the MACD RSI momentum is not very unique or special. It's actually one of the most common approaches used in the Forex market, and it does extremely well, as you can see by this percentage of profit. Now this is a stop loss based approach, which means it's lump sum trading. One position, either take a profit or take a loss. So here we have the context of that whole process. For the purposes of a stop loss, the entire premise revolves around risk versus reward. How much are you willing to risk to get the reward? And there's actually different ways of calculating that information. In the real world, athletes do it all the time on the basis of the risks they take for the sports they play. Now, of course, there are things you can do to mitigate your risks, like specialized equipment, training, education, so forth. In trading, the same thing applies. You can trade with the trend or other different means of changing the amount of risk you take. But for the basic context, all price action has a 50% chance of going up or a 50% chance of going down. Basically a 1-to-1 reward to risk ratio by default. Now you can trade with the trend, or you can use a 2-to-1 ratio, so forth. For the purposes of a stop loss, let's start with the most basic elements within this module. The most basic element is to simply sell by strategy. So whatever the strategy says, however it lines up, we get out. End of story. Get out when the strategy says sell. Doesn't matter if it's a profit, doesn't matter if it's a loss, just when the strategy sells, clear it out. That has the advantage of quite possibly being a very high profit basis. That could also be an organic loss. You never know. Sometimes that's too much of a risk. So traders will often use other means of determining an exit point that will yield better reward to risk confirmations. And that is what is next in line. Let's start with the easiest. A 2% take profit versus a 1% stop loss. The easiest above all, as you see on the screen, the green line is 2% above the price we get in, which is the blue line. The red line is 1% below. the blue line, or the price we get in. Now, the true mathematics here is statistically the green line only has a 25% chance of success over the red line. If a 1-to-1 is 50% either way, then a 2-to-1 is only going to be 25% chance of success. But yet we see here it's done well, and we made a 2% profit. We've taken 3 total wins on this approach with 1 loss, and we have profited 1.3%. So it's a simple approach, but it works well. That is the point of this process. It's not always appropriate to every market, but for this particular asset in the Forex market, USD JPY is really quite profitable with this approach. But there are other approaches that we need to explore. For assets that have very little volatility, meaning they barely move, then we want to look at this particular combination. And that is the pip. Now, oftentimes you'll hear about 20 pips or 10 pips and you're good. Now, this is still a 2-to-1 reward to risk ratio. My stop loss is 25 pips below my entry price. My take profit is 50 pips above my entry price. And as you can see with the Euro GBP, it is a 0.41% profit. Now that doesn't sound like much, but for the Forex market, that's a lot. You're talking about an asset that has very tiny movements, very, very little volatility. If you're coming from the crypto market where you're used to 2,000 pips a candle, here is, as you can see in the price action on the right-hand side, very small amounts. A 2,000 pip candle here will give somebody a heart attack. They're just not used to seeing it. So, realistically, small amounts for the Forex market do exceptionally well. And as you can see, you're not really in the market that long. But again, reward versus risk. You need to make sure you understand the market itself in terms of which method works best. A pip method does not work on a large amount of markets because the price action is too unstable. Likewise, a percentage method, as demonstrated here, will not work on a large number of markets because the price action is too wide, too spread out. So, as you decide your approach, you need to look at the market structure you are studying. And there are definitely more markets to deal with. For example, we have the ever classic support and resistance. And this is on the basis of candles. So in this case, we have a 200 candle look back for resistance, a 200 candle look back for support. And as you can see from the profits, minus 0.0089%. So this is a loss. So let's take our support to 400. And we have a bit of a profit. But now let's go up to, if our support is 400, then in order to have a 2-to-1 reward to risk ratio, we need to have 800 for our support. And there you have 0.31% for support and resistance for USD JPY. That's profitable. That's good. It's not as profitable as a percentage-based, but it's profitable. And a pip-based system is equally not profitable at all. So as you can see, each method of a take profit or a stop loss must be appropriate to the asset you are trading. So let's look at the last one, average true range. This was a very big requested item. Now let's do a 21 ATRs versus 7 ATRs. This is actually a 3-to-1 reward to risk ratio. If you want to do a 2-to-1, then it would be 14. And again, it is in profit. Not as much profit as percentage, but it is in profit. So there's 4 methods that the new stop loss module can take. It can do percentage, it can do ATR, it can do pips, and it can do support and resistance. As a method of both take profit and the stop loss, and one of the biggest requests that was made is, can it do it individually? Meaning, can you set a take profit of 2% and a stop loss of 7 ATR? Well, yes, you can. That was a big request, that you could use each component separately. Of course, trying to calculate out your risks versus rewards is going to be very difficult with this approach. But as you can see, it does do it, and it does do it very well. And one of the big requests is that ATR be a trailing, which you can see on this chart. It actually did not make the actual profit, but it did trail and made a profit from the trailing. So you can mix and match the different types of take profit and stop losses appropriate to the instrument you are trading. And this combination does work on Forex, stock items, and cryptocurrencies. Each one will behave different, appropriate to its own market dynamics. For example, this particular setting will not work on a large number of cryptocurrencies because of the volatility. Let's see if it'll work on a stock. Let's see if it'll work on. Okay, let's get out of this. Let's take AT&T. Will it work? Well, it's making a loss. It's lost 0.18%. Can it be tuned? Yes. Let's see if we can tune it. Okay, looking at two different trades. Given the fact that market volatility isn't all that great, let's see if we can get a 1% profit. And we can. Okay, so now let's look at it. Now we have a 0.76 total profit. We have 5 wins and 1 losses. So as you can see, you do need to tune appropriate to the instrument you are trading. Not every instrument is going to behave the same. This is not a one-stop-fits-all situation. You need to carefully tune it based upon each market's circumstances. Let's try with the S&P 500. Let's see how it looks. It has taken a loss of 0.39%. And as you can see from the charts, it looks like it's even smaller ratios than AT&T was. So how do we actually capture this market? Well, that might be a whole different type of trading strategy. For example, maybe we should try trade by strategy. Sell when the strategy says sell. And that's worse. So let's see what else we can do. Okay, let's see. Let's do 21 and let's try 14. Okay. I don't know that's making things better for this asset. Of course, the trading strategy itself plays a role, and that's something to factor in as you're looking. But that gives you the ideal. Let's try the last one. Support and resistance. And this is represented in number of candles. And of course, you can change the ATR length. Now that works. Support and resistance is a 0.47%. With 4 trade cycles completed, all 4 of them being a winner. But of course, your risk to reward ratios are different. Not a 1-to-1, not a 2-to-1. In this case, it looks like it's much smaller, which is fine because it won all 4 of its trades. So based upon your fees and the necessity of your trading, those considerations need to be considered. So now let's see how this works with cryptocurrencies. Okay, let's go to Bitcoin. Now you are dealing with literally 2,000 points of volatility. Well, support and resistance actually does well, quite well in fact. For the last roughly 3 months of data, it has done 0.89% profitability. Of course, depending upon your fee exchanges, that will most likely be closer to 0.6% after you pay your fees. But still, this is an example of risk versus reward. Now let's see what happens if we change it. Let's go to 14 ATRs. Okay, 14 ATRs does well. So you're taking on less risk for a stop loss. It looks like you have made the successful number of trade cycles. And there isn't a change in your profitability. So you can use a trailing ATR as a part of this mechanism, and it works well. How would it work with a larger reward? Most likely you would have more losses. But that is what you need to balance out between your risks and your rewards. And of course, not all markets are going to be good markets. A market that's trending downward, you would need to make a short instead of a long position. This is a long position. But as you can see, your reward to risk ratios can be calculated differently and appropriately to your own personal trading situation. The new stop loss module is significantly more adept in being able to adjust it to your own trading style based upon the methods you feel is worthwhile for your risk assessment. Risk and reward are both contextual in that they only matter to you. If you are happy with this approach and you are happy that you are making profits, with the difference between the reward and the risk being slanted for higher risk than reward, then this is perfectly acceptable. If you want to see better rewards over risks, then you would need to tune your recipe and your trading tactics to achieve that standard. The biggest lie and deception on the market is that you have to accept a 2-to-1, 3-to-1, 4-to-1, or some magic number of reward to risk. All that matters at the end of the day is that you pay your fees, you make money, and you are comfortable with the approach that you've chosen to trade. Remember that the lower the reward is in relation to your risk, the more likely you are statistically to hit that reward over your risk. If a 2-to-1 is 25% success compared to a 1-to-1, then a 3 to 1 is only going to be 12% success compared to a 1 to 1, assuming the market has a 50-50% chance of moving either direction. And that really is how you have to look at the market. Now, again, trend and other methods to put the statistics in your favor should be used. But your first consideration should always be the very basic premise that the market can move either way equally. Hopefully this covers all of the module's new capabilities and how it works. It's important to remember, pick the right approach for the market you are trading. Not every market works the same. And second, pick the right approach appropriate to your personal financial situation and risk assessment. Even with these upgrades, I still personally prefer an accumulation approach. But if you trade the Forex market aggressively, then you know beyond a reasonable amount of doubt, the Forex market traditionally is based upon a stop loss. And that is just simply accepted within that market. So that is something you need to think about as a part of your trading approach. If you like this video, be sure to hit that like button. Subscribe if you're not. Leave me a comment. Let me know what other suggestions you have for the stop loss module. How can it be extended? Is it going to do what you think it will within your own trading systems? After all, that is the most important part. Whether it's Forex, crypto, or stocks, if you can't trade efficiently with a proper reward to risk, then it's not going to be beneficial. And as I said, I've had a year's worth of suggestions, and they have helped me really improve this module. So please keep them coming. Until next time.